recording. Okay.
Okay. Well, hello, everyone. My name is Jill Gershutz, Chair of the Board for the Hilliard Area Chamber of Commerce. It is great to see so many faces today on this Friday. And what's more exciting is we have a couple new members who are joining us for the first time, and they will have an opportunity to unmute themselves and take a minute to talk about their business. So first, I would like to introduce Tim Moore with Operation Restoration.
Yeah, hi, good morning, everybody. I actually didn't know what to expect when I first got on here. I thought there might be just a few people, but this is great to see a lot of faces on here. So my wife and I moved to Hilliard about 3 years ago. So we're Hilliard residents, and my wife's a school teacher at Bourbon Academy. It's a private institution for kids that have dyslexia and ADHD. I own Operation Restoration. Our office is in Worthington, Ohio. But I thought it would be beneficial to join the chamber in Hilliard for the company. Been in construction my whole life, over 20 years, and just really happy to be on here. We do water mitigation, structural dryouts, fire and smoke cleanup, contents manipulation and cleanup, and then also we do some mold remediation as well in the Columbus area and surrounding. So thank you for having me.
Thank you. And next we have Sharon Delay with Go HR.
Good morning, everyone. So again, Sharon Delay, and a couple of my team members are on the call with us today as well. So I own Go HR, and we provide outsourced HR services for small businesses. The majority of our clients are in the Central Ohio and Ohio area, but we do have clients throughout the United States and several other states as well. So if they are based in Ohio and have other offices elsewhere, that's how we often end up in other states. We provide full service, full cycle HR. So to make it simple to think about it, everything from hire to fire. And a lot of what we do could just be kind of the bat line for people if they have a quick question, but in many cases, we're on site 1 day a week or twice a month for a lot of our clients as well, acting as their HR function within their offices. And we're thrilled to be new members of the Hilliard Chamber. We have all been working remotely since 2019, but 2 of my employees work out of a remote office over in Hilliard. So we decided to join. Plus I've been a speaker at Hilliard events a few times over the years. So thank you.
Okay, thank you and welcome to both Tim and Sharon. Some chamber news is more of a huge thank you to all of our members throughout the trying times we have had these past few months. And you know, what's wonderful is just seeing how businesses continue to support each other during this time and trying to keep the calm waters and keeping our businesses solvent as well. So we look forward as the Chamber to continue our efforts to support you and to bring relevant content and do what we can to help you through the next year as well. So hopefully you all have received your Chamber dues information that came out at the end of November. If you have not received that, reach out to Libby at the Chamber office and she can send you that information. That is due the end of January. So thank you to everyone during the past year, and we look forward to next year and continuing to work together here in the Hilliard business community. And if you do have interest, we are planning our 2021 luncheon events. We do offer 2 sponsorship opportunities where you can take a couple of minutes to talk about your business, and it is also publicized leading up to the luncheon as well. So if you have interest in an upcoming luncheon for 2021, please reach out to the Chamber office for that as well. And at this time, I will introduce Libby.
Hey, thank you very much, Jill. Just a couple things. We have some member benefits that we like to sort of highlight at some of these, and I'm going to highlight 2 of them. One is with International Bank Card, who can do your credit card processing. We have switched to them, and we are saving a lot of money on our credit card processing. And they are doing a special right now, because I have a flyer, it's going to be on our website too, but they put together a special offer for our chamber members, and it's a guaranteed monthly savings of 15 to 30% of current processing costs. So whatever you're doing, they will be able to save you that money. And Jeremy Felix, who is our representative and also on our board, can maybe even increase that from 30% to a higher number. So you also get a free terminal loaner program, and they will give you a $200 statement credit. I mean, who does not want free money? I know free is my favorite word, you know, all of that. So that's an opportunity to really check your finances going into 2021 to see how the chamber can help you save some money to reinvest in your business. Another benefit that we have is a pharmacy card. It is a free card, and it is for anybody in your employee. So if you're a business owner and all of your employees can also have this. I use it personally, and I've saved money on my personal prescriptions. So it's even if you have an insurance prescription plan, you can actually save more money with this as well. So if you have a generic copay of $15 or higher, the card will give you generally a more discounted price. Again, we'll have that on our website. Cardholders' price on 21 to 25 of the most frequently used generic drugs have been lower than insurance copays of $15 as well, as I said. So it's a great opportunity, again, for your employees to have it. Again, it's free. No cost to you, no cost to us. And if it's something that you can provide to your employees or yourself, that's something we really want to stress, especially right now. So let me find my notes again. So we're having a really great event with Heritage Golf Club next Thursday. This coming Thursday, the 17th. It's a bourbon virtual cocktail party. So for an hour, Mike, who's a food and beverage director at Heritage Golf Club, will be teaching us 4 different bourbon cocktails. So with that $50 investment, you get a bottle of Green Label Weller Reserve, and you also get a rock glass, which is really fun. It's a wonky one. So with the ice for the mold that you will also get, you can put your ice, your sphere in there, and it melds the bourbon perfectly, he says. So it's a really fun glass. And then the 4 recipes are a Manhattan, a Manhattan old fashioned, hot toddy, and a bourbon mule. So you can enjoy the hour with us. There are going to be some giveaways that we're all going to be doing too, and some fun trivia. So if you are interested in that, if you're a bourbon drinker, if you're not, this might be the time to try that special cocktails that you might have been hearing about from all your friends. So you have to sign up at HilliardChamber.org, and we will send you all the information to do that. But we're getting great response from that. So, and it's open to everybody. You don't have to be a chamber member to participate. So, you know, join us. It's going to be a lot of fun. So looking forward to that. So what I need to do is we're going to do and we'll do this afterwards. It's a business spotlight for our February issue of everything that we sent out for our email and so forth, highlighting your business. But I guess, Jill, give me a number between 1 and 50. Just a number.
32.
Okay, well, that person is Tizzy Nuss from the Sparks Project. So we will give you, yes, great. So you'll be our February business spotlight. We will send you the information on how you can promote your business, because what she does is spectacular. Yeah, really entrepreneur. So that is what all I have for right now.
Okay, well, great. We'll get on with our speaker. First of all, I do want to, if anyone has any questions they would like to post, just use the chat box down at the bottom, and we'll get to those at the end of the presentation today. So it is my pleasure to introduce Dr. David Berson, Nationwide Senior Vice President and Chief Economist. David earned a doctorate in economics and a master's degree in public policy from the University of Michigan, and a bachelor's degree in history and economics from Williams College. He is a frequent speaker to media and industry groups on the economic outlook, housing and mortgage markets, as well as the author of numerous publications. His commentary has been on Bloomberg, CNBC, Wall Street Journal, Reuters, and the New York Times. Prior to joining Nationwide, David served as the chief economist and strategist and head of risk analytics for PMI Group Incorporated, where he was responsible for analysis and forecasts of the economy, housing, and mortgage markets, domestic global research and planning, and strategic planning. He also acted as a PMI spokesperson on global economic topics related to housing and mortgage market conditions and policies. As head of PMI's portfolio management, analytics, and pricing group, he was responsible for all credit analytic models and projections for the company, as well as product pricing. Welcome to the Hilliard Chamber meeting, Dr. Berson.
Jill, thank you very much. It's a pleasure to be here. I'm just a few miles, maybe a mile outside of Hilliard where I live, so I'm very close. Talk about the economy over the last year. It's been unusual, and talk about where we see the economy going over the next year and maybe even a few years after that. So 10 months ago, February of this year, the US economy finished the longest expansion in US history. We've got data back to about the 1830s, and we don't really care what happened before that. So the longest expansion in US history. Then, of course, the coronavirus hit. So it was a downturn unlike any other. In about a month, because the economy was expanding through February of last year, actually a little less than a month, real GDP growth fell at a 5% annualized rate, with most of the quarter growing. That's how steep it was. But we didn't see anything at that point, because in the second quarter, the drop in the end of March leading into April and then the beginning of May, real GDP dropped at the fastest pace ever on a quarterly basis, even worse than any quarter in the Great Depression. So we're not talking about the Great Recession of 10, 12 years ago. That's small potatoes. The Great Depression never saw a quarter as bad as the second quarter of this year. We've never seen an annualized decline of 32% ever in the US. Well, governments caused the economy to shut down, perhaps for good reason. They didn't want people to die. And at that point, we didn't know how infectious the coronavirus was, if you got it, if you would live, if you would die, who would survive. Governments, particularly state and local governments, were being extraordinarily cautious. And in doing that, they shut down broad swaths of the economy, hence that huge drop in economic growth. But starting in May, we saw parts of the economy reopening as governments allowed more activity. Now, the first things to respond were the parts of the economy where people could work from home. Nationwide, for example, 99.5% of the employees worked remotely during this period. We didn't skip a beat. So financial services did fine, information technology did fine. What didn't do fine were obviously companies that depend on face-to-face activity, because they were the ones that the government was primarily trying to shut down. Why? Because you didn't want face-to-face contact. So starting in May, the economy started to rebound. And just as we saw the biggest drop in economic history in the second quarter, we saw the biggest increase ever in the third quarter. The third quarter, annualized growth was 33%. Great. We went down 32, we went up 33. We must be better off than we were, right? No. So think of it this way. Let's say level of GDP was 100, and then it fell by 50%. We'd be at 50. To get back to 100, we'd have to double. We have to grow at 100%. If we just grow at 50, we're only going to be at 75. So growing at a faster rate in the third quarter still left us well below where the economy was when the recession started. In terms of economic activity, in terms of employment, we were still far below where we were at the beginning of the year. Now, in the fourth quarter, where we are now, there's great momentum going into the economy now, which is good because we're starting to see things slow with another significant pickup in the COVID-19 infection rate, much higher than we've seen at any point during the pandemic. Governments are shutting things down again, not nearly as severely as they did in the spring. I don't think there's much stomach anywhere to have that sort of lockdown again. But the government restrictions are severe enough. We're seeing, and we will continue to see for some months, some significant slowing of the economy. Weekly unemployment claims, for example, probably the best near-term, almost real-time indicator of what's happening in the job market. Weekly unemployment claims have been coming down consistently from the beginning of May to early November. November, it started to stabilize. Didn't go down, didn't go up, stable. The first week of December, we saw a big jump up in weekly unemployment claims. Why? Well, governments, again, shutting down or holding back business activity, again, because of the virus, and businesses laying workers off. So we have, for this quarter, this tremendous momentum into like early to mid-November, and then the economy slowing again from government mandates. Overall, we think economic growth is going to be about 5%. That's pretty good. If you think about economic growth from the end of World War II to the present, it's averaged a little over 3%. And if you just look at the period after the Great Recession, so starting in the middle of 2009, economic growth has been a little over 2%. So 5% is still pretty good, but the trajectory is bad. Strong for the first half of the fourth quarter and very weak into the second half. When will we get past this weak point? We know looking ahead that vaccines are coming. The FDA's panel recommended yesterday that the two-shot vaccine from Pfizer and BioNTech be approved under emergency use authorization. We will probably, presumably the FDA will then say yes today. We will see vaccines beginning. People start getting jabs as early as Monday. And we'll see perhaps 15 to 20 million people, at least with their first inoculation, before the end of this month. By the middle of next year, with Moderna coming shortly after, Pfizer, and then AstraZeneca, J&J, and others, we'll basically be awash in available vaccines by the middle of the year. That's the middle of the year, not the beginning of the year. In the beginning of the year, the current jump in infections is going to continue. Now, it will start to come down as we go through the first quarter, but we're going to see a really slow first quarter. Governments aren't going to relax their mandates until they start to see infection rates move down significantly. Hopefully, that's before the end of the first quarter, and we'll get some momentum going into the second quarter. It's hard to know right now. All we do know is the first quarter is going to be very weak. It's possible, even though it's not currently in our forecast, that we could have negative GDP growth for the first quarter. Negative 32% again? No, it's not going to be nearly that bad. We've learned to live to some extent with the coronavirus. Governments aren't going to shut us down the way they did then, but we've already seen significant mandates. So we will see much slower growth, perhaps modestly negative growth in the first quarter. But with the vaccinations coming, we will see the economy opening up again, hopefully before the end of the first quarter, certainly in the second quarter. The second half of the year, we're going to see maybe the best economic growth since 1983, 1984. It's going to be really strong. For all of 2021, remember what I said about growth on average since World War II, been a little above 3%, and since the Great Recession, a little above 2%. For next year, we're looking for growth at about 4.5%. That's inflation adjusted. That would be the fastest growth since the mid-1980s. It's pretty good. Unemployment will come down. It's already come down a lot. If I look over here, my home office has like 4 PCs running. I look like a trading desk. So my PC over here to my right, when I look over here, has my database. So I'm looking at data over there. So I can look at all of you over here. If you look at unemployment, I don't have it for Hilliard, but for the Columbus metro area, it's 1 month behind the national numbers. Unemployment in October was 5% for Columbus. It was just about 7% for the US as a whole. Now, the Columbus MSA usually has lower unemployment rates than the US as a whole. There are parts of the US where unemployment is lower than Columbus, certainly. But if you look at the US average, Columbus usually has lower unemployment rates. Job growth is usually about the same in percentage terms, but unemployment's lower. So it's substantially lower. It's about 2 percentage points lower. Now, Columbus, unemployment will drop next year. We'll look at some charts in a minute. Unemployment will drop next year nationally. By the end of next year, we think unemployment nationally will be about where it is in Columbus today, about 5%. Down today, it's about 6.7%. That's a pretty good drop. It's still well above where we were in February. In February, again, the last month of the longest expansion in US history, the unemployment rate was 3.5% nationally. 3.5% was the lowest national number in 50 years. 50 years is a long time. I would bet a good portion of the crowd here today wasn't alive 50 years ago. So the lowest unemployment rates in your lifetimes was in February. In Columbus, the unemployment rate then was also about 3.5%. And that's also not the lowest in Columbus. In the second half of the 90s, unemployment was a little lower. It was 2.5 to 3%. So Columbus historically has had very low unemployment rates. But 3.5% is still very low, just not as low historically as it was for the US. So getting back to about 5% nationally is not 3.5%. It's a big improvement, but it's going to be several more years before we see the unemployment rate in the US get back to where we were in February. Now, historically, if we got to numbers between 4 and 5, that's been pretty good. But we know the unemployment rate can get as low as 3.5. Why don't we go for that? Well, again, historically, there has been a relationship, an inverse relationship, meaning they move in opposite directions between unemployment and inflation. So typically, when the economy is running hot, unemployment is very low, you tend to get higher inflation, typically. So when the unemployment rate gets too low, when inflation starts to pick up, the Federal Reserve starts to tighten monetary policy to slow the economy. Or as a Fed chair in the mid-1960s said, our job is to take the punch bowl away just when the party gets good. Because you don't want inflation. Inflation is bad for businesses, it's bad for households, it's bad. So if the Fed starts to think inflation is going to rise, or if inflation has begun to rise, historically the Fed has tightened monetary policy. They do that by raising short-term interest rates, and long-term rates tend to follow. So interest rates go up, it becomes harder to borrow, the economy slows. Sadly, the Fed knows this, doesn't have complete control over the economy, and historically it has tended to tighten too much, trying not to let inflation run out of bounds. And we've then had rates go up too high and recessions have followed. That is typically, in fact, in almost every case, that's how we get recessions in the US. The Fed has tightened too much, trying to keep inflation from rising, and we've gone into recession. That's not what happened this time. In February, with that 3.5% unemployment rate, again, a 50-year low, inflation was pretty low and there was no sign it was going up. In fact, the Fed had been easing for about 6 months going into that, realizing that there was no inflation, there was no reason for the Fed to tighten. The Fed has a long-term goal as their primary goal for monetary policy of getting inflation to be about 2%. Now, Congress chartered the Fed, and Congress gave the Fed 3 goals. We only usually talk about 2. One, and you combine them into one sentence. The Fed is responsible for helping the economy have the lowest unemployment rate consistent with stable prices. Low unemployment, stable prices. Now, mathematically, stable prices would be 0 inflation. But the Fed has defined it for various reasons to be 2% inflation. Inflation's run well below 2% for most of the last decade, not just in the US, but around the world. central banks have not been able to get inflation to go up to that 2% goal. So a month ago, the Fed said, all right, because we've not been able to get inflation up to 2%, financial markets don't believe that's really what our goal is. We're going to now change how we operate. That 2% goal is going to be 2% on average. So if for a while inflation runs below 2%, we're going to allow the economy to run hotter and get inflation to run a little bit above 2%. How much above 2? They didn't say. How long above 2? They didn't say. And in both cases, they don't know because they've never done this before. So the Fed is going to keep monetary policy easy. They're going to keep the pedal to the metal on short-term rates, effectively zero, for at least the next couple of years. We don't have the Fed tightening in our forecast till the end of 2023. So at least another 3 years of zero short-term interest rates. Long-term rates are affected by those short-term rates, but they also depend upon other things. The Fed very closely controls short-term rates. Long-term rates depend also on what financial markets think inflation will do. So financial markets think inflation will go up, long-term rates will rise. If borrowing demands go up relative to the amount of funds available, demand going up relative to supply, prices go up, interest rates will rise. So there are things that will cause long-term rates to go up, even if the Fed is holding short-term rates at zero. Indeed, we've seen that over the last few months, where we like to look at the yield on the 10-year Treasury note, riskless, presumably riskless. The federal government, we think, will always pay us back, so there's no credit risk there. But those rates have gone from about 0.75 of a percentage point to about 0.9, 90 basis points today. So look a little bit, and we think they will continue to move up modestly over the next few years. By the end of next year, so today they're about 90 basis points. By the end of next year, we think that 10-year Treasury note could be maybe 1.25 percentage points. Now, the 10-year Treasury is important because a lot of private, non-federal government interest rates come off of that, mortgage rates being the principal example of that. Mortgage rates today are the lowest they've ever been for a 30-year fixed rate loan. They're averaging about 2.7%. 2.7%. I remember when my wife and I bought our first house up in Ann Arbor in 1978, and we got a 7.5% mortgage rate. And we knew our parents back in the early to mid 60s had gotten mortgages much lower than that. In fact, those mortgage rates were about 4 or 4.5%. So we were outraged. But 4 and 4.5% seems so high today when you get a mortgage under 3%. So as interest rates move up, as the 10-year Treasury rate moves slowly higher, other longer term rates will move slowly higher as well, such as mortgage rates. But they're not going to jump unless somehow inflation takes off and the Fed says, oops, and they really start to tighten monetary policy. Long-term rates probably won't move up very much. Borrowing rates at the longer end won't move up very much, but at the shorter end, they're going to stay just darn low. Basically, no change at all. Let me show you some of the charts. So now, let's see. I have to go to here. I have to go to here. And I have to, no, it's not there. I have to go to the bottom. I have to go to share screen. That's it. And, oh, here we go. We'll go to this. And we'll click share. So do you see the economic outlook? I hope. And we're going to go from the beginning. There. So do you see the cover slide? Good. All right. So that's all very well and good. Here's real GDP. And economists always talk about GDP because it's a nice overall view of what's happening in the economy. I've worked for many companies. I've worked in White Houses. I've worked at the Fed. There is no company that sells GDP. I've worked for really big companies and small companies. There's no company that sells GDP. When I worked in the White House, the president was interested in GDP. And when I worked at the Fed, chairman of the Fed was interested in GDP, but otherwise, it's just an example of what's happening in the overall economy. So you can see the blue line, and that was history. Going up in the dotted horizontal line was the peak. The peak for GDP was the fourth quarter of 2019. And that huge drop, I could have done a GDP chart back 100 years, and that drop we saw in the first half of this year would have been the biggest decline ever. Our forecast, the blue dotted line, goes up, and you can see the very strong increase in the third quarter, and then it slows down very much. Some this quarter, but a lot in the first quarter. What I said before, the virus has picked up again. Governments are putting mandates on. The economy's slowing. It's possible, you don't see any declines there with the dotted blue line, that we could see a small decline in the first quarter, but then it goes back up again. Economists have talked about various shapes for this recovery, a U-shaped recovery, a W. This looks very much like a V, the down and then the up sharply. Few things to talk about here. Note that even with many years of growth, while by the end of next year, we think we will get to the level of economic activity that was the all-time high at the end of 2019. Without the COVID recession, in all likelihood, the economy would have continued to grow. So you see the dotted orange line or tan line, because it depends on what the screen looks like. And it continued to go up at about 2% per year. We're much farther away from that than we were from the level of economic activity when the COVID recession started. We don't get back to the level of economic activity that we would have been at if COVID hadn't hit, probably for another 4 years. That's a long time, but it shows how deep this recession was. Now, we think the recession ended, given the great growth in the economy in the second quarter, probably the second quarter, maybe as early as May, perhaps June. That will make this the steepest recession, but the shortest recession ever. You know, the Great Recession started in December of 2007, and it ended in June of 2009. That's a lot more than 3 or 4 months. This was very short, but again, very, very deep. Unemployment. Well, nationally, the end of 2019, the unemployment rate in the US was down to 3.7. As I mentioned, in February, which was the peak for the economy, the unemployment rate nationally and also in Columbus was about 3.5%, 50-year low. For all of this year, we expect the unemployment rate to average about 8.1%. Well, at 8.1 has a lot of variation. We were at 3.5 early in the year. We're at 6.7% now, but in April, the unemployment rate was about 15%. And because of some errors in the way the Bureau of Labor Statistics, and they are the ones who brought this to everybody's attention, the way they coded some of the answers to their survey questions, the actual unemployment rate was probably not nearly 15%. It was probably near 20%. So we went from effectively 3.5% unemployment to nearly 20% in 2 months. Again, much worse than even the Great Depression. I mean, it's almost unbelievable, except we've lived through it. We know in those 2 months how bad things were. But by the end of this year, we only have 1 more month. Unemployment's probably going to be 6.6, 6.5 perhaps. Next year, on average, 5.9%. The end of the year, we think unemployment will probably be around 5%. With the economy continuing to grow at a pretty good pace, in 2022, we think unemployment on average 4.7, probably end the year around 4.3%. And in 2023, averaging 4, we're finally starting to get to the level of unemployment that we were at when the COVID recession hit. Look how long it takes to get there. And that's even with pretty strong growth over the next 3 to 4 years. That's how deep the downturn was. Inflation's going to be very low this year. Inflation always goes down in recessions. It's going to pick up. Now, why the pickup and then the decline, the pickup in 2021 and then it slows in 2022? Well, we're not the only country in the world picking up speed. The world's going to recover in 2021. That will probably put some upward pressure on important commodities like oil. So the big reason why we get the jump from 1.1 to 2.3 is oil prices going up. And then they'll stabilize.
I assume there are various.
So we think we'll get inflation basically averaging around 2% for the next several years.
Common hurdles that people tend to have.
Somebody probably should mute their line
Better their own communication style.
because I hear somebody else talking. I'll just talk louder. So that's still not over the Fed's.
David, 1 second.
Go ahead, Libby.
It's Corey Best. If you could mute yourself, please. Or everybody mute yourself if you're not. I can't do it. I'm no longer in control.
There we go. We got it. Thank you, Corey. So inflation around 2% for the next several years. That's around the Fed's goal. Will the Fed tighten monetary policy with inflation like this, or do they need to see inflation go up higher? We don't know. The Fed has never done this before. We don't know how the Fed is going to react. How high does inflation actually have to go before the Fed starts to tighten? We think this will be high enough with inflation around 2% and edging slightly higher for the Fed to start to tighten at the end of 2023, but we'll see. What's going on in the real side of the economy? Vehicle sales. Obviously lower this year, but at one point, April, they were lower than on an annualized basis than at any point during the Great Recession. But they picked up a lot. And we think next year we'll see auto sales. These are light vehicles, so it's autos, it's cars and SUVs and minivans and pickup trucks. Over 16 million, and that's pretty good. Now, look to the left and you can see we were running around 17 million for several years. That's the best we've ever done in the US. More light vehicle sales than we've ever had over a 4-year period. But many people had bought vehicles. They don't need to buy vehicles again. They last a whole lot longer these days. So probably over the next several years, the best we can do is somewhere a little over 16 million units. So it won't be quite as good as what it was before we went into the COVID recession, but it's still pretty good historically. How about housing? Now, note that the COVID recession is in 2020, yet home sales are going to be substantially higher this year. This is a really unusual circumstance. It is very rare when home sales go up in a recession, because the most important factor that people look at when they decide to buy a home, because almost all of them have to borrow money for a long period of time in order to buy that home, is what their job and income earning prospects are. And in recessions, those prospects usually aren't very good. Yet we expect a big jump in home sales this year, and an even, not a bigger one, but another increase next year to a higher level. These are the strongest home sales numbers since the housing boom of 2005 and 2006. Why so strong? Well, remember I mentioned letters of the alphabet. What does this economic recovery look like? The U, the V, the instead of V, that the GDP look like a V. The way to look at this is it's a K. Think of a small, uncapitalized K. So we have that big drop. And then you've got an up and a down. Most of the economy, because most people are working and most people have been working. Most of the economy, most workers are in that upward part of the K. They're seeing the lowest mortgage rates ever. They're seeing their incomes go up. Those are pretty good drivers for housing activity. The down part of the K are people in retail and leisure and hospitality for the most part. And they're hurting because unemployment in those areas still very high. And I think those areas will continue to see high unemployment until we have widely used vaccines and government mandates are effectively eliminated, even if there's some there, and people are willing then to go out and do face-to-face contact again, which they're not willing to do right now to a great extent. But there's a third thing that is helping to push housing activity up, and we're calling that a desire for space. What does that mean? Think of how many firms are having their workers work remotely. Many. And many of them are saying, well, this is working out really well. Never come back. You can come back if you want to, but if you don't, work remotely. There are a lot of workers who are already working remotely who will want to work remotely for a long time. Maybe not every day. Maybe they'll come into the office 1 or 2 days a week, 2 or 3 days a week, 4 days a week, maybe 5 days a week, week after week after week. They can do their job from home just as well. They'll do that. Well, it may be that they need an office, home office, because the kids are running around, or they don't need to be in the central city. They can go anywhere. Where's a really nice place? Could be anywhere. Could be Hilliard. You don't have to live in downtown Columbus. You can live in Hilliard. So we're seeing this tremendous demand for housing. Now, what's interesting is we've never had fewer homes for sale, never meaning data back to 1980. We've never had fewer homes for sale than we do today. So we have this big pickup in demand and not a lot of homes to sell. If we had more homes to sell, the housing numbers, the home sales numbers here would be even stronger. That's certainly the case in Columbus. I know it, the southern part of Dublin, so again, bordering Hilliard, I know it's the case in my neighborhood here, almost certainly true in Hilliard as well. There aren't many homes for sale and people want to buy them. The net impact of that is it's pushing up home prices very rapidly. Don't be surprised. Now, there are lots of ways to measure home prices, but the appropriate way is we probably give you home price gains from a year ago on a national basis, up about 8%. It's pretty good if you own a home, not so good if you want to buy. Good thing mortgage rates are so low. But when mortgage rates start to move up, and with house prices so much more expensive, home sales will start to go down. And that's why we think home sales will start to go down as we get out 3-4 years from now. Well, I mentioned we hadn't had home sales this strong since the housing boom. We haven't had house price gains this strong since the housing boom either. Does that mean we're setting ourselves up for the housing bust? And I was the chief economist at Fannie Mae in that period of time. I know what the housing bust was like. I know what the boom was like. We used to joke, and it was some joke, that the only test you had to pass to get a mortgage was the mirror test. You know what the mirror test is? Well, many of you probably use, some of you might. If you put a mirror under your nose, what happens to the mirror? Well, it fogs up as you breathe out. Well, congratulations, you get a mortgage. If it doesn't fog up, you're dead, you don't get one. But that was maybe the only test. So the big difference between now and then was anybody could get a mortgage. Didn't matter what kind of mortgage. There were lots of inappropriate mortgages then. Lots of people calling me too. Lots of inappropriate mortgages then. Today, it's almost impossible to find an inappropriate mortgage. Mortgage underwriting is really tight relative to where it was during the housing boom and really where it's been historically. So we don't look at this as another housing boom followed by a housing bust. It's not like that. Interest rates. So here we have the federal funds rate. This is what the Fed uses to conduct monetary policy. See, in 2018, they were tightening monetary policy from 16, 17, 18 as unemployment went down and down and down, and the Fed was convinced it would cause inflation. It didn't cause inflation. In fact, inflation went down. So the Fed said, all right, maybe we've made a mistake. They started easing monetary policy. lower rates, and then in 1 month, in March, they brought interest rates to zero. Now, this was very different than what the Fed did during the Great Recession. When the recession started, they started to ease monetary policy, slowly brought the federal funds rate down, but didn't get to zero for months and months after the recession started. It got to zero weeks and weeks after the recession started. Now, the Fed has never moved this quickly. Part of the reason why, along with governments allowing economies to open up, part of the reason why the recession was so short. And we don't expect any tightening till the end of 2023. If this forecast is wrong, and I'll tell you, every forecast is wrong. The question is whether it's wrong by a little or a lot, and whether you have a good story to tell. If this forecast is wrong, I think it's more likely that the Fed won't start to tighten until after 2023 rather than before 2023. So again, those short rates effectively at zero. And then finally, long-term rates. Here's the 10-year Treasury. These are year-end numbers. Those 2%, 2.5% rates seem so high today. The 10-year Treasury earlier this year fell to 0.5 percentage point, an all-time low. And today it's about 90 basis points, so 0.9%. Seems so low. If you were in Germany and you looked at the 10-year Bund, which is their equivalent of a 10-year Treasury note, it's minus 60 basis points. Minus. You buy the German 10-year Treasury and you don't get all your money back. Here, at least you make a little bit of interest. But in much of the world, interest rates are negative. And they do that to try and get people not to save, but to spend, to boost their economies. It hasn't worked very well. Negative interest rates are a bad policy. So hopefully they won't do that here. And the Fed has said they're not going to. You can see that we expect long-term rates to edge slowly higher in coming years. But even by the end of 2023, that's not a very high rate. It's lower than anything we saw before the COVID recession. The 175 would have been a record low until we got to almost zero in the COVID recession. So let me just sum up. We're going to have a tough next 2 to 3 months with infections picking up and governments locking things down again, but not as bad as what we saw in the spring. But as vaccinations become more widespread, as governments remove those impediments to growth, we're going to see growth pick up over the course of next year and be really, really strong in the second half of next year. Inflation perhaps picking up a little bit, particularly for oil prices, but interest rates staying low, particularly for short-term rates. Unemployment dropping, not getting anywhere close to where we were, but still dropping significantly from where we are today. So let me stop there, and I'm going to stop sharing my screen. Stop share. There we go. All right. Time for a few questions. What did you really want me to talk about?
Okay, David, anytime you want to switch it back to me as the host, that would be great. That way.
How do I do that?
Okay. Well, don't worry about it. We'll figure that
No,
out.
I'm happy. How do I do it?
You go to my name.
There's your
And
name.
then in the 3 dots, I think.
Yes.
It'll say to go to host, co-host.
Make host.
Yeah.
You got it.
I am now the host. Thank you very much. Jill, did you want to ask the questions, or?
Sure, that's fine.
There's some in the chat.
I see 2 in the chat. Do you want me to go
Yeah.
over them?
Yeah,
do
go
that?
right ahead.
So Mitchell asked, how do you expect the Fed to avoid raising short-term interest rates when we have inevitable inflationary pressure in coming years due to all the monetary and fiscal stimulus? The answer is, I think the Fed will have to raise rates, but not now and not in the short term. All of that, think about at the end of the Great Recession, when at that point we had what was then record federal fiscal and monetary policy stimulus, and inflation didn't pick up then. The things that have caused inflation to stay low, the expansion of information technology throughout every facet of our lives, isn't going away. It's only intensifying. And the move of production to low-cost areas, that's not going away either. It may have moved away from China. In fact, China is no longer really a low-cost production area. It's going to other parts of Southeast Asia. Wait till it gets to Africa, which is really low cost. It hasn't gotten there yet, but it will eventually. That doesn't mean inflation can't go up. And indeed, we think inflation will get to 2%. But the Fed, remember, is going to allow inflation to get up a little bit. How much, again, we don't know, above its 2% goal before it starts to tighten monetary policy. Within 10 years, will the Fed tighten? Yeah, we think the Fed will tighten in 2023. Will inflation have moved up a lot because of the things you mentioned? It may have. I hope not, but it's possible. It is a real risk to the economy that not in the next few years, but when we get out to years 5, 6, 7, 10, that inflation does pick up a lot. The Fed will have to start taking liquidity out. And you've got another question. Speak to the danger of raising rates too soon. This is sort of the converse of your first thing. So the Fed can make two policy errors. They can tighten too slowly. They can tighten too quickly. The too slowly one is the thing that might let inflation go up over time too much. The too quickly is what would cause the economy to stumble sooner rather than later. So, I've worked for the Fed. It's hard because inflation is a backward-looking indicator. So if you look at inflation today, 1.25%, it's based on things that happened 6 and 12 months ago. So to really get a handle on inflation, you got to forecast what's going to happen and forecast it well 6, 12, 24, 36 months in the future. We're not good at that in terms of prices. We're just not. Nobody is. And the Fed is no better than anybody else at that. So they make errors. The question is it worse to make one error over the other? Over the long run, I think it's worse for them to have not tightened enough to let inflation go up. Just remember what it was like in the 70s and the first half of the 80s when we talked about my first mortgage at 7.5%. That was the lowest mortgage I got till the 90s. When mortgage rates, when we moved to California, I was assistant professor. The mortgage we got in our home was 18%. We do not want to go back to 18% mortgages. That would be bad. All right, we have a new message. Cynthia, speak to how the Fed was able to pump trillions of dollars to help the banking system. Basically, they didn't need approval of any other governing body. Well, some of it they needed the approval of, and some of it they didn't. Their normal operating procedures allow them, because they have their charter from Congress, to have the lowest possible unemployment rate with stable prices. Inflation was going down, unemployment was going up. They didn't have to get Congress's approval to ease monetary policy. It's in their goals that Congress gave them. And what they do is they buy securities that banks have, and they give them cash, essentially. It's all done, so it's electronic cash. So depository institutions have fewer financial instruments and more electronic cash. And the hope is that they will then lend that out and it helps boost the economy. And to some extent, it does work that way. And it worked this way. It worked this time too. But they did more than that. And Congress, in the CARES Act, gave them the authority to do more than that with various lending programs. Now, the Fed didn't do a whole lot of those lending programs. And so Treasury Secretary Mnuchin asked for that money back, and he's getting it back because they didn't lend it all out. They had a lot more money the Fed could have lent out than they did. Much of that was supposed to go to small businesses. That program just was not written well. And Congress doesn't write programs well. Republican, Democrat, doesn't matter. They don't write programs well because it's a very complicated process, and you've got 400 plus Congress people trying to write, and then 100 people in the Senate trying to write something. Think about people in your office writing a memo and having 5 of them trying just to get the wording on a memo. To do a law is much, much worse. So it was not written well. And so the Fed basically said, look, we're not quite sure what you really wanted us to do. Hopefully, if there's another PPP program or something like that, it will be written better, and it will be written to be targeted far more for small businesses. And I mean small businesses, not the mid-sized ones. All right, from Tim, when do you think lending institutions will loosen up financing for commercial capital markets? To some extent, they've loosened up a little bit now. I think there's a concern about what I talked about, the desire for space. There's a concern that you have space in downtown Hilliard, and who's going to want to move in there, because your customers are all going to move out to Plain City. They can get 10 acres and I guess a farmette or something like that. I'm not sure I want 10 acres, but some people might. So there's uncertainty about when commercial real estate will fill up again. And it's not just in Hilliard, downtown Columbus, downtown Cleveland, downtown New York, downtown San Francisco. Will Goldman Sachs want everybody to move back to their buildings in New York? Probably not. What will they do with all that space? They may sublet it, they may try to sell it, but they won't get the prices they would have gotten a year ago. So part of what's going on with commercial capital markets is that uncertainty. Now, we're sort of at peak working remotely now. Companies will start to have people come back in the office. I don't know, we'll get back to where we were, we probably won't. But it won't be as much working remotely as we do now. So some of that space will fill up. And as that space starts to fill up, I think financial institutions will start to loosen up financing. And it's going to take that. Time for one more question. Oh, there it is. Kevin, an indication of a new administration coming in, the tax rates are going to go up. Ask me on January 6th. Because on January 5th, there are 2 special elections in the state of Georgia. Those are seats currently held by Republicans. If even one of those seats is continued to be held by a Republican, Republicans will have a 51-seat majority in the Senate, and they will control what happens there. If both seats go to the Democrats, it will be a 50-50 tie, and Vice President-elect Harris will be the deciding vote. That makes a huge difference on lots of things. It will make a huge difference on things like tax policy. Now, it only takes one Democrat to vote with the Republicans to not have a Democratic majority. And there's lots of things in which some centrist and conservative, not many conservative Democrats, but there are still a few, will vote with Republicans. And the other way around too, with a 51-49 or a 52-48 Republican majority. It doesn't take many moderate Republicans to vote the other way to have the Democrats get something. So I think we will see some changes and probably some tax increases, but not big ones, not the ones that President Biden had in his proposals, unless both seats go to Georgia and the more moderate Democrats in the House are willing to do that. So we'll have a better idea on January 6th, because again, the election's on the 5th. All right, we got one more question. This is the last one, and then I have to go. I've got to go back to work. Plus, the Fed buying large quantities of corporate debt over the summer to prop up markets. So the Fed did buy it. So in the Great Recession, normally the Fed only buys Treasury securities, no credit risk at all. During the Great Recession, the Fed also started to buy AAA mortgage-backed securities, mostly securities issued by Fannie Mae and Freddie Mac. They weren't going to go. Those securities were going to be fine, even though we had a record number of people defaulting on their loans. Securities themselves had so many millions of, thousands of loans in them, or millions with big ones, that those securities issued by Fannie and Freddie weren't going to go bust. So it was a little more risk, but not a lot. As you start buying corporate debt, the risk goes up. AAA corporate debt, are there any AAA companies? Not many. AA, single A, there's not much. Is there some risk? Sure. If we actually had another Great Depression, again, we were close, some of that could be downgraded. But they were able to buy BBB debt, and BBB is the very bottom of the credit scale. If you go below that, it is various levels of junk. So BBBs, you do have some concerns about. I have concerns about that. Now, most of what they bought wasn't that. They bought a small amount of that. So is there the chance that they will take some losses on that? Yes. Does it matter really at all? No, it doesn't, because they didn't really borrow very much. And even if they did, the Fed would be bailed out by Congress. And the Fed doesn't have to be bailed out. They just print their own money. So they would print the money and stay solvent. So I'm going to stop there, Libby. If you all like me, you should invite me back again next year.
Absolutely. Dr. Berson, thanks so much for your time today. That was great, very informative. And thanks to everyone for attending and being a part of this today. More information about the January topic and luncheon will come out at a later date, so stay tuned for that. Thanks to everyone. Happy holidays and have a great weekend.
Thanks, everybody.